Imagine Warren Buffett personally mailing you a check every single month. No, not a folksy thank you note. I'm talking about a cash-loaded mailbox stuffing check backed by Buffett's stock picks. And juiced with a 15% annual yield. Paid, outside, monthly. Yep, monthly money from the GOAT of long-term investing. And no, you haven't entered some dividend-paying fever dream. This is the Buffett-backed ETF that's turning income investors' heads and making JEPI look like it's stuck in retirement. Today we're diving into OMA, a new ETF you've never heard of, but your portfolio might be begging for. Is it genius? Is it dangerous? Is it Buffett with a side of covered calls and chaos? Buckle up. This is not your grandpa's index fund. First things first, Buffett doesn't pay dividends, never has, never will. He hoards cash like a dragon, reinvests it, and lets compound interest do all the magic. Which is great if you don't need income for the next 30 years. But what if you want to eat before age 95? Enter OMA, the Buffett, but make it rain monthly ETF. It takes his top holdings, the Apples, Cokes, and Bank of Americas of the world, and adds a juicy twist. Covered call options equals income machine. It's like giving Buffett's sleepy buy and hold strategy a double espresso and sending it to Wall Street. But wait until you see how they actually do it. It's wild. Let's cut to the chase. OMA targets a 15% annual yield paid monthly. Yes, you heard that right. While JEPI is still texting you, hey, once a quarter, OMA is showing up with a bouquet of cash every 30 days. If you put $100,000 into this ETF, you could be seeing around $1,250 per month in income. That's rent. That's groceries. That's your dog's custom organic meal plan. But before you throw your Roth IRA into the fire, here's the question. Is it sustainable? Let's peel back the curtain on how this sausage is made. Here's the play. OMA uses covered call strategies to generate all that sweet, sweet income. Translation? They rent out the upside on the stocks they own. They're saying, hey, Wall Street, you can maybe have the next Apple rally for a fee. That fee becomes your income. Brilliant? Yes. Limiting? Also yes, because here's the trade-off. When the market goes full beast mode, your upside is capped, like a soda bottle that's been shaken and sealed. Sure, you're getting monthly cash, but if Apple surges 20%, you might only see 5%. Welcome to the land of predictable income and neutered growth. So here's where it gets spicy. If you're the kind of investor who wants to accumulate wealth, OMA might cramp your style, but if you want monthly cash flow, it's basically financial Disneyland. JEPI, 7 to 9% yield. JEPQ, 8 to 11% maybe. OMA, 15% with a wink and a warning. That's a massive jump, and also a red flag for some. But let's not jump the gun. First, who is OMA actually made for? 3 people. Retirees who want monthly paychecks without burning their principal like it's kindling. Diversifiers who already own growth monsters and want some reliable income sprinkled on top. Buffett fanboys who cry themselves to sleep because Berkshire doesn't pay dividends. But here's your friendly red siren. OMA is not a one-size-fits-all miracle fund. It's concentrated in only about 20 stocks. You're not buying the whole buffet, you're ordering a la Buffett and paying a premium. OMA's expense ratio? 0.95%. JEPI? 0.35%. S&P 500 ETFs like VOO? Practically free at 0.03%. So, OMA is not only eating into your upside, it's charging you nearly 1% annually for the privilege. You've got to ask, is that worth it? Well, if it performs as promised, sure. But if that income starts wobbling like a Jenga tower in a windstorm? Here's the fun sucker punch. OMA's income isn't qualified dividends. It's taxed as ordinary income. So instead of getting the sweet 15 to 20% qualified dividend tax rate, you could be paying up to 37% depending on your bracket. Translation? That glorious $10,000 yield might only be $6,300 after Uncle Sam takes a bite. Pro tip: hold OMA in a Roth IRA or 401k where taxes can't find you. If you want growth, Berkshire all day. If you want steady income with lower fees, JEPI. If you want monthly checks and don't mind a few battle scars, OMA. Look, every ETF has skeletons in the closet. With OMA, here's what could go wrong. It's new. No real track record. High yields are historically hard to sustain. Option income can dry up in volatile or low-volume markets. Did I mention the taxes? Yeah, I did. They still suck. If you're going to roll the dice on OMA, start small, like 5% of your portfolio. Monitor the payouts. Compare it to JEPI, JEPQ, and BRKB. See how it holds up. You don't test a parachute midair, and you don't go all in on a brand new ETF with a brochure full of promises. OMA is exciting. It's fresh. It's the ETF equivalent of Buffett going on spring break. But it's not perfect. It trades upside for income, it's pricey, and the taxman is waiting with a fork and knife. If you're building a diversified portfolio, here's a spicy combo. Berkshire Hathaway, BRKB, for long-term growth. JEPI for consistent income with lower risk. OMA for a small experimental income booster inside your IRA. This ETF could be JEPI's worst nightmare. Or it could be the financial version of Icarus flying a little too close to the dividend sun. So here's the million-dollar question. Would you trade future growth for 15% annual income now? Let me know in the comments. I want to hear how you'd play this. And if you found this helpful, funny, terrifying, or all of the above, smash that like button like it owes you rent, and make sure to subscribe for more clever investing breakdowns, hot takes, and ETF smackdowns. And remember, just because Buffett doesn't pay dividends, doesn't mean you can't get paid. Catch you in the next one.